Hi, everyone. Thank you for coming in. Right now, we're just checking in, and I'm asking Dorothy to share a little bit with us about the offer that she put on the property and see if
Yes,
we have any advice for her, or anything, or just any talk before we get into our conversation.
yes, ma'am. Good afternoon, Abere. Good afternoon, everyone. Thank you, Abere, for allowing me to share this deal. I sent a letter to a seller through my direct mail marketing campaign. The
Mhm.
seller and his wife called. I went to look at the property. I put an offer on the property. The property had a great deal of debt on it. It was a good cash offer, but the seller felt that if he renovated the property himself, he could walk away with $300,000 to $400,000. The after repair value on the property was a little over $1 million. Actually, it came in at about between $1,065,000 to 1.1. There is about $225,000 in renovation. It is a total gut. There was structural damage as well. Um, my offer was $532,000. Me and my rehabber, we were set to go look at the property on Thursday, but I just received a call from him right before we talked. And he said that he feels that even though he is an out of state owner and the property is vacant, he could put 150 to $175,000 into the property, manage the property from or manage on the renovation from another state and walk away with about $300,000 to $400,000 in cash. I thanked him for his time and told him and his wife that if they change their mind, to please feel free to give me a call back.
All right. So thank you for sharing. If he had accepted the offer of 532,000, how much would you have made in the deal?
I would have made about 53,000 and some, well, actually about 41,000 and some change.
With an offer of 532?
Well, that was the offer to him. That was not the offer to my buyer. So my offer to my buyer would have been a higher than that.
Oh, so this is a wholesale deal.
Oh, of course. Yes, ma'am.
Okay.
Yes. I was going to wholesale it. I apologize for not making that clear.
All right. Thank you for sharing that information. Does anybody have any comments for Dorothy? Let me put this, I wrote down the specifics. So ARV is about 1,225,000 of renovation, and there is some structural damage. She offered 532. She was gonna wholesale it for about $41,000. So total in is about 600,000.
Actually total, well, yes, actually total in would have been about 572. But Barry, I'll tell you this as well, because they would have walked away with a substantial less amount of money. I talked to my buyer, and we talked about buying it subject to existing financing,
Mhm.
and that's what we were going to meet about on Thursday. But one of the concerns with the seller was, with he and his wife's excellent credit, they did not want to risk
Mhm.
my buyer not making the payment on the mortgage. And I assured him that with my buyer investing almost $250,000 of his money, and we would be going to a title company, and this would be a settlement, his wife paying or I'm sorry, my buyer paying his mortgage would be paid for. And I also assured him that there would be a contract in place, spelling out everything that would take place. And he thought about it on Thursday. He and his wife were, they thought about it, and we made the appointment. But when I called to confirm it today, he said, he would rather not.
All right. So does anybody have any comments, or what do you think a counter offer could be or could have been on this deal? Based on everything that you've heard, what do you think that a counter offer could be or could have been on this deal? Anyone want to attack?
Could she possibly meet them halfway? I know that they mentioned that they're looking to profit, I guess, over 300 and something thousand. So could she meet them halfway? Also, too, does she know what their reasoning for selling? Why are they looking to sell?
Yes. Thank you for asking that question. They they are not motivated, to sell right away, and they let me know that from the beginning. And so the house is vacant. But in terms of meeting them halfway, for example, we would be into it for a little under $300,000. But when you look at closing costs, recordation costs, he's gonna have to pay, her mortgage. Let's say, they renovated the house for 4 months, and at 2,500 times four, that would be $10,000. But it's probably going to take more like 6 months, and so with the rehabber, me and my rehabber, I'm taking the risk, them getting $150,000 or $125,000, or us meeting them halfway, will not be feasible.
The other thing that I thought about, I don't know if this is possible, if one of the concerns that they raised was by doing it subject to, meaning they didn't trust whether or not the payments were going to be made. Isn't it
Correct.
possible then that the payments could just be rolled in as part of the cost of the purchase and given to them up front, or even possibly just made on the so have a place where that money is given to them and they're using that to make the payments rather than the rehabber having to make the payments every month. If he's looking to be in about 6 to 8 months, then maybe just giving them that money up front.
Okay, and that is something that I did not propose to them, but thank you. But what we did talk about, that there would be two closings, that they would receive a certain amount of money at the first closing,
Mhm.
and then once the property was renovated and sold, they would receive uh, an additional amount at the second closing. But to what you said about, paying them up front so they can make their mortgage payment, that's an excellent idea. Thank you, and I will I'll call them back to propose that as well.
Yeah, and I did agree a little bit with what Barbara said. I don't know if anybody else has any comments, but I was thinking that what are the chances that an out of town investor would do well on an almost $300,000 renovation? I think that's a bit much, but I can also see where they're not wanting to just give up the equity on the property. I would, if I were in your shoes, I would offer them a 50-50 proposition. Like, let's make this work in such a way where each party walks away with 50% of the profits. They might be open to that because I don't know if they have this $300,000 to do the rehab or even dealing with, the contractors and all that. Are they going to be able to do that? And then on you guys' end, this is a a good deal that I would not walk away, quickly. I would be looking for other alternatives. Does anybody else have any comments, anything? Femi, you want to say anything, or Wayne, you wanted to say something? Go ahead.
Yeah, I was just thinking if your buyer has the money to do the deposit 250,000, why not go into a contract with them to do the renovations, and at the end of it you both sell it, have an agreement, and then they get their part, their share, and you take your share.
Uh,
Which is true.
okay, and I maybe I'm misunderstanding you, but that's something, Mr. Wayne, that I had alluded to before. Um, so to make sure I understand, or basically what I said was they would walk away with a certain percent at the first closing. The property would be renovated, and then they would get their 50 the remaining balance once the property was sold. Uh, did I
R- r-
misunderstand you,
What?
Mr.
No,
Yeah,
Wayne?
what?
well, I'm talking about avoiding closing, get into a contract with them for the renovations, and
Yes,
you use that money towards the renovation also. And then at the end of it, since you have an agreement, and once it's sold, then you give them a certain percentage, whatever you agree to, and you take a certain
yeah,
percentage. And you have more money for renovation since it has structural problems and they're
yeah.
out of town.
Okay. Um, all right. So that's something that I would have to discuss with my buyer. And the caveat here is when I was going to present the offer to the seller last week, after I did the numbers, I realized that they weren't going to walk away with a lot of money at all. So I called my buyer and asked would he be open to a subject to existing financing before I actually met with them, and he said yes. But because of my limited experience with subject to, all the questions were going to be addressed on Thursday coming up, but we didn't get that far because the seller, called me today and said that they weren't interested.
Yeah, I think the point that Wayne is making is that if they were going to come up with the money to do the rehab anyway on their own,
Yes,
having a relationship with somebody in DC on the ground that can supervise and do all of that,
correct.
that if one of the things that they're open to is not only is it subject to, but they also bring the money for the rehab. And in doing that, then now is a matter of this, is this an arrangement where this can be a 60-40, 80-20, 70-30,
Okay.
50-50 split?
Yes.
In other words, I think what I'm hearing is don't walk away from the deal currently. Find another, like look at 2 or 3 other counter
Okay.
offers and
Okay.
then, yeah, see if you can re-engage with them.
Okay. Thank you, Abere. Thank you, Mr. Wayne.
You're welcome.
All right, so I was supposed to have a mystery guest today. Unfortunately, they canceled and are not able to make it. So I will be your mystery guest, and I'm sure you guys are probably happy about that. No, I'm kidding. Um, so I will cover a few things that I'll say that has happened in the last 1 week with different clients, and then you guys can just ask me questions. And then this is our last annual business meeting. Again, if you have not yet scheduled your one-on-one with your team lead, please reach out and let's get that scheduled. This is the one time in the year that we have time to talk about everything that is not necessarily tax related. You can still reach out to us the rest of the year, but usually May, June is when we're reaching out to you like, hey, let's talk, let's look at what we have going on with you outside of just taxes. So I'll talk about one client. One of the issues that came up is we have a client who is being offered to go abroad. And in order to go abroad, they're gonna get a higher salary, almost 60 or $70,000 more than they're making right now in the US. But the consideration is if they move abroad, is it gonna be an indefinite move? What happens with taxes? There's a hypothetical tax calculation. What is happening with all of this? What's the tax impact? So I'm still working through the numbers, but what I suggested is that we do 3 scenarios. A 2025 scenario where they don't move, so that's scenario 1. A 2025 scenario 2, where they actually move, but it's an indefinite move. Because in order for you to get the foreign earned income exclusion, your move to a foreign country needs to be indefinite, meaning that you do not intend to return to the United States, which is called a relocation and not necessarily an assignment. So if you intend to relocate overseas without an intent to return, you do get the foreign earned income exclusion. So one of the things that we're looking at is what will that look like if they do a relocation and not an assignment? That's scenario 2. But then we also have to look at scenario 3. Scenario 3 is where they're being sent on an assignment. They're still an employee of their company. They're still working overseas. They're still paying taxes here. They're still getting all the benefits. Because if they do a relocation and not an assignment, they are now going to be working for the foreign what you call it, subsidiary. So they're not going to get all their benefits. The 401k, they no longer need to contribute to Social Security, their medical benefits, all of that would be lost. So the third scenario is what are all the benefits that they get as a result of it being an assignment, meaning they're still working for their employer. And then I'm going to look at those 3 scenarios and come up with the difference in numbers. All right. Does anybody have any questions on foreign earned income exclusion or what happens if you decide to move to another country? Oh, another situation that came in with another client in terms of moving to another country was whether or not they would not have to pay taxes on income that they earn in the US. So if you still are offering business services in the US, even if you're in a foreign country, you do have to pay non-resident income tax. So as a US citizen, you are taxed on your worldwide income. So even if you're in a foreign country offering services on US soil to US residents, you are responsible for paying non-resident US taxes. So that's something to keep in mind for those who may be thinking about it, considering it, or just want to know. Any questions before we move on?
Yes, what about if you stay out of the United States, it's not indefinitely, but you're a contractor, let's say, and I think you're only allowed to come up 30 days to the States per year or something like that.
Yes, but the whole goal is that originally when you leave, the intent is not to return. So it has to be an indefinite stay. But if you do come back to visit, yeah, it can't be more than 30 days.
Okay, all right.
Any other
Question.
questions?
Yeah, another question. How do you show an intent not to return? You have to have like a contract or
Yes,
paper.
and they also look at things like what happens to your home here. Did you rent out your home or
Mm,
did your family move with you? The residence that you got in the foreign country, do you own it? Do you rent it? Driver's license, all of those things is what they will be looking at to show that it's an indefinite stay.
got it. Thank you.
Mm. Any other questions before we move on? All right, the next question that we had was about cost segregation. A client was thinking about cost segregation and they reached out to us to know whether that's something that we could handle. And so we told them that we are able to handle cost segregation. So there's 2 things in handling cost segregation. There's what we call the desktop cost segregation, just like when you do an appraisal, where you have a desktop appraisal and then you have the professional appraisal. If the cost segregation that you're doing is on a commercial deal, we suggest that you get the professional engineering study cost segregation. Because it's commercial, there's a little bit more that is involved and then the amount of money that is involved. But if it's residential, we can handle that in-house because we have a cost segregation worksheet where we look at all the different components that are included in a residential property and we go from what we consider the building, then what do we consider the land, then what do we consider the 5-year property, meaning anything, personal property, anything that you can move from the property without causing any structural damage? What would we consider repairs? What would we consider improvements? So with those 5 different categories, we are able to do an in-house cost segregation in order to accelerate depreciation. But the other thing that we also look at is it doesn't make sense to do cost segregation if it's not going to benefit you. So the first thing that we look at is cost segregation beneficial? Meaning you're claiming all this depreciation in the first year. Is it going to reduce your AGI? Because if you are not a real estate professional, meaning that you don't spend 750 hours in real estate and not or more time in real estate than in any other active profession. And if you have losses and you make over $150,000, you will not be able to use that loss. So it does not make sense to say, oh, I'm going to do this cost segregation report. I'm going to pay all this money for something that you don't use. That is what we call wasted deduction. So you need to make sure before you even embark on a cost segregation study that this is something that will help you on your tax return. And then just know that there's a difference where you get the full-blown professional cost segregation versus the desktop one, which we handle here in-house. Any questions?
I have a question. So the desktop, is that something that's done automatic with all your clients, or do we have to request that?
You have to request it because it's a separate charge to do it. We charge $750 to do the cost segregation.
Okay. And then when you bifurcate it, are you bifurcating just the land and building, or are you doing land building? I think it's capital improvement. Well,
Yeah,
land.
it's five. It's five. Actually, you know what I can do real quick? Let me share my screen so that you guys can see the report that we use to do the cost segregation. So hold on. Okay, if this PDF will work today. All right. Okay, so let me share my screen. So this is the report that we use for the cost segregation study. As you can see here, this is 9 pages, and we literally have to go through this first one we're looking at is personal property item, the dishwasher, the garbage disposal, the windows, the blinds, the mirrors, the ornamental fixtures, all of that. We go through all of that, hot water heater, carpet, and everything. We come through and we calculate what is personal property. And then we do the tax citation reference on how we are considering this to be 5-year property. The next section that we work on is furniture. Furniture is also depreciated over 5 years. So we will go and look at bar stool, chairs, lamps, tables, everything that is pretty much furniture. We would reclassify those. Those will be 5 years. So, and then we have the tax citation for that. Then the next thing that we look at is land improvements. What kind of improvements are being done, whether it's pavements, driveways, parking lots, streets, concrete, patios, sprinkler systems. We would calculate those and segregate those out. Those will be depreciated over 15 years. And then the next one that we look at is the building portion that's just based off of the improvement. We will do that and we will segregate that out. Then we now look at the land improvement that has to do with the building. We do that and we segregate that out. Then the next thing that we look at is land. How much of the land, what percentage of the land is non-depreciable? You cannot deduct land. We will do that and split that out. Then we look at the schedule of the structural components and then see if there's anything in the structural components, roof and light and plumbing system, all of that. We will segregate that out. And then the last one that we look at is the repairs and maintenance. What things are considered repairs? Meaning it does not extend the useful life or improve the value of the property. You're just trying to maintain the property in its current rentable condition. We will segregate that out. And then after we finish that, then we now have a summary at the bottom of all 5 classes. So as you can see here, it's 5 classes. It's repairs and maintenance, which is 1. Then we have land, which is 2. Then we have improvements, which is 3. And then we have building, which is 4. Then we have land improvements, 15 years, that's 5. Then we have furniture, that's 6. And then we have personal property, that is 7. So 7 different categories that can now be depreciated accordingly. Okay, all right, so let me stop and take any questions about cost segregation.
Hey, a very quick question. So let's just say one purchased a business and that business is earning a substantial amount of income, but you're not really managing the business. You're still focusing most of your time in fitting the category of a real estate professional. Would that difference in income between the business earning and your earning trigger an audit?
What do you mean trigger an audit?
Like, so if you file the taxes, would the IRS, would they look at it and say, well, maybe this is that okay? Is it still okay to still file the cost segregation if if it fits that category?
Yes, because cost segregation doesn't have, remember now you're talking about a business. You're no longer talking about property. You can still do cost segregation on a business. In that case, the losses are not even limited, because the whole thing about the losses being limited is if you're a real estate professional. But if you're not even dealing with property, you're not dealing with real estate, you're talking about a business, you can do cost segregation all day long. It doesn't have anything to do on whether you're actively involved or not. The active involvement that I was talking about is for real estate, not for other businesses.
All right, thanks.
You're welcome. Any other questions before we move on?
I have one. So, in the case of a real estate professional, would you say that for the most part it would make sense for them to do a core seg?
No, because remember what I just stated about wasted deductions? You first of all have to see what benefit is this cost segregation. That's why we prefer to do, especially those that have residential, it's better for us to do it in-house, or that we do this analysis during your year-end tax planning, because that's when we're figuring out, is it going to make a difference? There are situations where you do cost segregation and you now end up having wasted deductions, meaning it would not have done anything for you. Or you claim all this depreciation up front, now you're in a negative AGI. It's not going to do anything for you. So the question that we usually look at is, you're doing cost segregation, is it going to bring down your liability? Not, is it going to put you into a negative AGI situation? And then there's some instances, like I think there was a client where we decided that we're not going to do cost segregation in 2024 because they are closing down their business in 2025. And we said if they're going to close down and sell their business in 2025, we want to be able to use the cost segregation on their rental property to be able to offset that sale. So it's also looking at future tax planning to see what else do you have coming on for the rest of the years. Does it make sense to do it now, or does it make sense to wait and do it later? Any other questions before we move on? All right, so the next thing that I dealt with this last week was an email about somebody, actually 3 people. Well, sorry, 4. And I realized I get a lot of questions on property sales. So we have clients that are intending to sell their property. Some located, let me look at the different places. One is located in New York, was looking to sell property in New York. Another one looking to sell property in Michigan. And then another one that's looking to sell property in Maryland. And so what are the things that we look into when somebody is talking about a property sale? I usually, just like Bridget asked Dorothy, why is this person selling? So I usually want to find out from them, why are they selling? In some instances, it could be because they're retiring, so they're getting tired. They don't want to do, they don't want to be an investor anymore. So they're trying to convert their asset into liquid form, like more of cash. Others, it could just be that they want to get another property. They're moving and they want to get another property that's closest to home. And then other people, it could just be, it was an inheritance. So they no longer want to keep this property and they're ready to move on. So the first thing that we do when a client says that they want to sell the property is the first thing is let's calculate what is your potential capital gain. Because any discussion that I have about capital gains taxes, whether you should do a 1031, whether you should consider doing a installmental sale, is all going to be based on whether or not you have significant capital gains. So the first thing that we do is to prepare a capital gains worksheet. What does your capital gains look like? What is the tax impact of that capital gain? Once I have this worksheet prepared, then now we can start going back and addressing the questions that the client has. Because it's not just about the taxes. In some instances, I'll say, you know what? Your capital gains is not that much. Please go ahead and just pay the taxes and be done. In other instances, they did not take into account. So I have a client, they did not take into account that they've owned this property for 20 years. So they did not take into account accumulated depreciation on the property. When you depreciate property every year, you get that deduction. When it's time to sell the property, you have to recapture that depreciation. So this client actually thought that they're only going to make this amount of money, and it ended up being huge because they did not take into account that the accumulated depreciation had to be recaptured. So now we have to start backtracking and figuring out, okay, what are all the options? So in some cases, we will suggest doing the 1031 exchange. In some cases where the client will say, I don't mind selling, but I just don't want to pay all these taxes up front. In that case, we recommend that they do an installmental sale. Please pay attention to this. Do an installmental sale, not taking back a note. When you take back a note, you have effectively sold your property and you are going to pay capital gains on the whole amount. So if you want to pay taxes gradually as you get the money every year, you're better off doing it as installmental sale, meaning as the person pays down the installmental sale note, you pick up the capital gains. This is different from you sell the property and you take back a note. You're going to have capital gains on all the properties. So you're going to have capital gains on all of the you're going to have capital gains taxes on all of the capital gain. In some instances, we also look and see maybe you should wait. Maybe you should wait and maybe sell this property at a later time. Like we had a client where they wanted to sell two properties. After we did the analysis, we said sell the property in 1 year and then sell the other one in another year. By them taking the strategy, they did not pay any capital gains. Why? Because if you're married filing jointly and your taxable income is under $75,000, you do not pay any capital gains taxes. So this is the reason why it's important to do the analysis and see where you are tax-wise before you decide to sell a property, because there's strategies that can be utilized to help to bring those taxes down. In some instances, we actually have clients who would sell, and then that's the year that we do the cost segregation to be able to, bring the cost segregation in with the capital gains and minimize their tax liability. All right. So that's it on property sale. Any questions before we move on?
I have a question.
Sure.
Just at a high level, with capital gain, capital gains is calculated separately from depreciation recapture. They're calculated separately and then they're combined, or is there like a
Let me share our worksheet. So the answer is that it's combined, but when we report it on the return, is reported separately. So that's the, let me pull up a capital, a sample worksheet so you can see what
Okay.
I'm talking about. Okay, sharing my screen. All right, so this is a sample property. So you can see here, what we will do is to calculate what the sales price is. Then we will do the closing cost, which is the settlement cost minus the loan payoff. Please pay attention to this loan payoff. You need to look at the difference between the actual loan balance and the loan payoff amount. Because if the loan balance and the loan payoff amount is not the same, you have additional deductions to get. Because if they tell you that the loan payoff is 215, but your loan balance is only 200, that means that there is a $15,000 either interest or prepayment penalty or all of that that needs to be picked up. So that's why you need to be paying attention to your HUD-1 when you're looking at the loan payoff amount. Usually they have a breakdown there to say, oh, this is the loan balance, this is the interest that we added, these are some prepayment fees and all of that. And we take all that into account here. Then now we look at the purchase price. We look at the refinance, if you did any refinance over the years, any renovations and costs that they put to pick it up. In this case, this capital gain is a little different because I think this is just a straight up rehab. This one here is not a rental. But if, let's say, this property was depreciated, let's just say it's about maybe $50,000, we would add that $50,000, and now that changes the capital gain. So let me take it out. So you can see here that this property has a loss of $8,600. But if their depreciation was $50,000, you can see now that they owe $41,000. The way that this $41,000 splits off on the return is that we pick up this $50,000 separately because that's the depreciation recapture subject to ordinary income. And then the $8,600 is going to be what is subject to the capital loss or the net gain and loss. So even though this is the overall capital gain, to answer your question, Ty, when we get to the tax return, it's split between how much of it is accumulated depreciation, then everything else goes into the net gain calculation in terms of how the taxes are calculated.
Okay, that's very helpful. I remember going down a rabbit hole just trying to understand capital gains, and I think to your point, a lot of people, including myself, get very, very confused on what's my final number going to be,
Yeah.
and
Because
yeah,
a lot of people, the way a lot of people calculate it is, what's my sales price? Hold on, let me share this again. A lot of people get caught up in what's my sales price. So they would look at just this amount. What's my sales price? My net selling cost this. And then they would subtract out whatever the loan amount is. And so now
Mhm.
they see, oh, those are the proceeds. So they're thinking that the net proceeds that they get at closing is the capital gain. No, that is not the amount. You need to literally go through this calculation. This we call the HUD-1 method. We also have another method when we try to tie it out where we call the cash method, which is how much did you put in? How much did you put to improve it? How much are you getting back? So if you're using the proceeds, you only have to use your earnest money deposit and how much you had to come up with that closing plus any improvement costs. But sometimes people are mixing apples and oranges, and that's why their numbers are not coming out right.
Right. And what you just said is something that I did. I just hard and fast just deducted the leftover, the loan
Correct.
and the cost, and it just as a hard and fast number. And I realized, oh, it's not that simple. So
Yeah. So
thank you
if
for.
you want, you can email us and we'll send you a copy of the sample capital gains worksheet so that you have it every time. Just come and dump it in. But if you're going to do the quick and dirty, just use the cash method, right? Cash
Mhm.
method is, what's your earnest money deposit? How much did you come with the table when you were closing on the property? How much did you put in rehab? That's your total cash in. Then cash out, you can say, how much cash am I getting at the sales closing table? The difference is what your capital gain is. but you can't look at the purchase price of the property and the loan amount and using that and trying to figure out the capital gain without doing the full calculation.
Got it. Thank you. You're a genius as usual in
Thank
explaining stuff.
you.
Thank you.
You're my new best friend. Thank you. All right. Any other questions on property sales before we go into the last topic for today? Okay, I see that Barbara Bridges is on here. Barbara, are you in a condition? Are you in a place where you can talk? I wanted you to tell us a little bit about the new business that you started.
Yes, hi, Ebere. Yeah, I can speak a little bit about it at this point in time. Currently, I am an independent licensed agent with World Financial Group, and what we do is we look at assisting individuals with a variety of different financial needs, of course, to either complement, supplement what you're already getting from, your advisory, but an advisory, whether it be IBER or some other advisory. But what we look at is retirement primarily, and then also in cases where people are having issues with a variety of different savings plans, and we have product providers that can support different types of savings based on your need. But where we specialize, I would say life insurance, and primarily looking at either life um, a term life insurance policy, uh, or an IUL, which is an index universal life policy, which is a very good policy structure to support cash, sort of a cash value savings component with, what is included with a death benefit. Also looking at long-term care, and living benefits. We look at so many different types of strategies to support individuals. And then also there is the annuities. And right now, there are so many promotions that are being run and offered on the different types of annuities, and offering bonuses to support individuals who are looking to park money someplace in the event, say, and they call it lazy money. If it's just sitting in the bank, it's not earning much interest. We partner with A-rated firms, and some of those firms are, many of those firms have been around for more than 50 years. As a matter of fact, 2 or 3 of them have been around for over 100 years, one being Nationwide. Then we've got Transamerica, we've got North American, and just it's at least, I would say, the suite of solution providers are above 50. And right now, we've got an Athene product that is an annuity that is offering 50% bonus on top of the money. So if you were interested in looking to place some money someplace for it to grow over a period of 10 years, that product is an excellent product, and it also includes the income structure that's associated with it. That means that if you were looking to take income in the next 10 to 20 years, it is a great solution for that. Zero fee on top of that. And so I could go on and on, Ibir. I don't really know. I don't want to take up a whole lot of time because this is sort of impromptu. So I don't know how much you want me to share, but we just got
No,
a
that's good
variety
enough.
of solutions.
Yeah, I saw you and I was like, oh, let Barbara come talk about it. So Barbara has been a client for a long time, has several rentals, doing very well, and she started this business. So if you are interested in us bringing back like a financial planner to talk about insurance or annuities or long-term care or the difference even between whole life and index universal, please just put it in the chat so that we gather that information. If you guys want us to do that, we can come back in July or August, and I can bring Barbara back on for the whole hour just to talk about financial planning. So if it's something you're interested in, just post it in the chat, and then we will take it from there. Thank you, Barbara.
Okay,
Um,
perfect. Thank you, Ibir.
you're welcome. One of the things about insurance that I wanted to talk about, there's something that happened. Yeah, so we had a client who was not able to get insurance because of their child being on the spectrum and also them having a medical condition. So they were not able to do the IUL, but we told them to do the term. And the issue was, should I be doing term because I really wanted to do the IUL? The advice that we gave them is look at how much money that you would have put away for the IUL and look at how much money that you can do for the term, because I understand that there are some terms that are 70-year terms. So you get a term right now. If you're 20 or 30 or 40 years old, you can get it for 50 years, for 60 years, for 70 years, from 30, for 40. What is the difference between both premiums? The difference between the term premium and the difference between the IUL premium. Invest that difference. And if you do that, even though you don't qualify for an IUL, you are still building generational wealth by taking advantage of investing vehicles that are out there. I do have some other questions that I'll ask Barbara, but I'll finish the last topic that I have. And if you guys want, I can ask her the question at the end. Okay, so now let us talk about trust and protection. So the other thing that I dealt with this week is a client put their property in a trust, but they also have an LLC, and their attorney told them that they did not have to open up a bank account for the trust. And so they were wondering, should we be doing this? Should we not be doing this? And they wanted to get my opinion. So actually, let me quiz you guys and see. Do you guys think that a trust should open up a bank account to run the day-to-day operations of a property that it holds? What do you think? What's your answer?
Yes.
See, that's why we're having this class. This is why we're having this class, because majority said yes, and the answer is no, absolutely not. So let me explain what the attorney was thinking, what the advice that we give, and then if you guys have questions on that. So the first thing is there's three arms of dealing with a property. You have the finance arm, who is bringing the money to the table, right? Then you have the title arm, who owns this property. Then you have the management arm, who is going to be managing this property. As much as possible, these three should not be talking to each other. So if you have a trust that owns the property, that is the title entity. You want that completely separate from your operating or property management entity. So that is why the attorney told them that they did not need to open up a bank account for the trust, because they already have a real estate LLC that they are going to use as the property management company. So they have a level of separation between day-to-day operations and ownership. It helps you with asset protection. The tenants are not having to know who owns this property. They're dealing with the property management company, and everything is just separated. You're not commingling. And then finance, anytime that you have to finance the property, let there be a separate finance LLC that brings the money to the table. It would either do it as a contribution or a debt to the property management company, and the property management company now handles the property. But if it's for purchase, it goes to the title company. The title company is now who buys the property. So the answer is no. You should not open up a bank account or have any kind of operations on an entity that holds title to the property. You want to have a separate property management company that handles all of the operations of the property. So for all of you that said yes, I'm open for questions.
So how would that apply, Iberi, to cash assets? I mean, I guess I understand what you just explained. It makes sense, but then there are your I guess your trust would cover everything, or that particular trust would cover all of your assets, or are we just looking at
so that's
the
where
real estate?
that's where you will talk to an attorney, but I would keep my property trust separate from my personal trust. that
Okay.
have all of my other assets. Because, yes, if you're talking about non-real estate assets, I can see where you need a bank account for those. But that's completely different from real estate, where you have dirt in the ground where somebody can sue. Because remember that a trust gives you privacy, but it does not protect you. It is not
Correct.
a
Okay.
limited liability company. So even if you have all these other assets that are not real estate, it's better to have one trust that deals with the properties and then another one that deals with all the other assets.
Okay. Thank you.
You're welcome.
So I
Any
want
other
to
questions?
make sure I understand, because this is
Mm.
really good. You're saying the trust itself should not be opening up or operating the bank account, but an entity that well, okay, this is what I'm understanding. Tell me if I'm wrong. An entity that the trust operates and owns, or a separate entity
No,
entirely?
completely
Okay.
separate.
Okay.
The comment is not don't open up a bank account. The comment is that a trust should not be actively managing the day-to-day affairs of the property. A property management entity should be handling that. So it's
Okay.
because the property management entity is handling the day-to-day affairs, that's who opens up the bank account to collect the rents and do repairs or whatever.
Got you. So it's more about separating the entities that
The
operate and
functions,
finance the
yes.
functions of the property, not, yeah. Okay.
And also for asset protection,
Mm-hmm.
because the one that has title should not be dealing with the day-to-day. If somebody's going to sue you, what name do they need to see? They need to be dealing with the property management entity.
Okay. Does that become, I mean, I know this is kind of crossing into legal and asset protection, but does that become quite laborious and administrative to have all these separate entities and
It depends on your assets and the equity. So that's a good question. It
mm-hmm.
depends on the assets and the equity that you have in the property. So for our clients, before we even get into this kind of separation of functions, I first of all determine what equity do you have in each property. So we look at each property, the current fair market value, and the loan balance, and the equity in the property. And in some instances, that's where it stops. 3 times whatever the equity is, just get an umbrella insurance and call it a day. For others, we now go further depending on, how much the transfer taxes is, recordation taxes, lien filings, and all of that. Does it make sense to move this property out of the current entity and then have it in its own separate title entity?
Okay, that makes sense. And then I think you've shared before, when a property is encumbered by a mortgage,
Mhm.
I want to make sure I'm saying it right. Like there's some
Level of protection, yes, because they
okay.
have to deal with the first lender. And
Mhm.
usually the first lender will not cooperate in any kind of lawsuit. The answer is going to be absolutely not. So yeah, if you already have an existing mortgage, the likelihood of that lawsuit making it is going to be slim to none.
Got it. Okay. Thank you, Miss Ebere.
You're welcome.
I have a question. So the rationale for having the bank account separate from the trust is for liability protection? Just
Yes.
having the extra. Okay, so now in the event, God forbid, something happens, would a tenant go after that property management LLC, or would they be actually going after the property of the trust?
The property management company, that's who they signed the agreement with.
Okay, they would go after them. Okay. And
Well, technically, they can go after anybody, right?
Mhm.
Being listed in a lawsuit is not the issue, is whether or not they have any jurisdiction. And that's where the attorney would come in and state you need to be dealing with the property management company.
Okay, okay. I have another question too, since we're on the topic of trust. So I'm not sure this is a question for you or if it's a legal question. So in the event if you have a property is titled under the LLC name, and now you create a trust and you now have to put those properties inside the trust, do you have to change title of those properties, or can you just change the membership ownership into the trust? So I have
In what name was it in the name of the LLC?
Yeah. So do you have to like retitle?
You have to retitle it if you really do want it to be in the trust. You have to change it in the land records because in the land records it's going to be the LLC. The other option, right? The other option is that you can have the trust now become the 100% owner of the LLC. So you're still doing the same thing because now what the trust owns is the LLC, not necessarily the property itself. But if it's a situation where you want the trust to own the property itself, you have to do a title transfer. And that's when I say sometimes it becomes cost prohibitive because depending on the state where the property is located, or for those in Maryland, depending on the county, you now have all these extra fees, legal fees, transfer taxes, attorney fees that you have to pay in order to do the transfer.
Right. And so in an attempt to avoid that, you said that you would have to make the trust 100% owner of the LLC?
Yes, so you
Avoid.
now have the LLC owned by the trust.
Oh, okay.
Mm-hmm.
And that would avoid the retitling of all those properties.
Exactly.
Mhm.
Mm-hmm.
Okay, thank you.
You're welcome. All right, so Jerry has, if a property has a mortgage and an insurance claim, does the claim get settled faster than if you didn't have a mortgage? Not really. Not really. I don't think it matters because the claim is a claim that is filed on the insurance company. And I'm so glad you brought this up. So the answer is I don't think so, but this is very important. Please, 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 if you have a property, please make sure that you have adequate insurance to protect you. Please do not skim on umbrella policies, hazard insurance. We've had a lot of people lose their shirt, lose their money because they thought, oh, nothing is going to happen. I'm fine. And boom, something that you did not expect ends up happening to that property. Okay. Any general questions? I do have a question for Barbara. But any other questions as we wrap up? We are at on the hour here. All right. I have a question for Barbara. This is something that I've never been able to understand. The difference between a whole life policy and an IUL. Is whole life that you're paying for the insurance throughout your whole life? Is that what it is? I don't understand the difference between the whole life and an IUL.
It's usually fixed. And what I mean by that is the cash value is fixed, the premium is fixed. There's literally no change. And that's really the fundamental part of the difference between a whole life and an IUL. And the IUL offers a lot of flexibility in how that payment can be made. And
Oh, how
part of,
you make your insurance payment and you
yes,
can front load it. Okay,
yep,
that I
yep,
know. Okay.
yep. I don't think that there's any company that offers the ability to add to a whole life payment. It's just what it is.
Okay.
I mean, if it was overpaid, that goes to the cash value. There's, with the way an IUL is structured, it allows for, application of funds to go to death benefits. It's a big difference, but that fundamental point is being fixed and not flexible.
Okay.
Yep,
Okay.
but it's still
Got it.
permanent. It's permanent life. Yep.
Okay.
Yep.
Got it. Thank you.
You're
All right.
welcome.
Any other questions?
I have another one. And I think I want to go, I missed the first one or two or three sessions. So, but what are your overall thoughts, Ebere, on things that we should, and I know there's a lot going on, but that we should be cluing into in regards to taxes and our tax situation, the stock market,
Yeah,
real
so I'm
estate.
gonna send out, we've been sending out the replays.
Okay.
So now that we have all four, we are gonna send out all four. Or if you didn't get it, just email me and we'll get it out. We do have it in the webinar replay if you're on Zoom, but also if you're in our email list, we've been sending out the replays. But the basic standard advice that I gave in terms of oh my goodness, it is too many things going on. I have a headache. The first thing is mental health. Please make sure you take care of yourself, love your family. If you're a religious person, thank God every day that you're alive. That's number one. Number two, start to look at your passive income. All of the unrest and everything that's going on, and whether you're going to have a job, you're not going to have a job, and immigration, no immigration, real estate, no real estate, you know, who's coming to DC and who's not coming to DC. All of this stuff boils down to one thing. Are you financially free? So that if anything happens, you are still okay. So the first meeting that we had, I suggested that everybody kind of take a look at your assets, the portfolio that you have. How much taxable income do you have? How much non-taxable income do you have? How much tax deferred income do you have? And then look at all of your assets. If you were to lose your job today, if the government decided to go to China today, if COVID happened again today and things were shut down, do you have enough money to sustain you where you did not have to worry about money? If the answer is no, then you need to look at yearly, how are you converting your assets into more passive investments? Like look at your real estate. Do you need to continue to pay down aggressively some of the debt on the real estate so that you're building up equity? Do you need to look at how much money you're putting away into your retirement account? Do you need to cut back on expenses so that you do have savings, something saved up for a rainy day? I don't know what the percentage is, but a high number of Americans are one paycheck away from going broke. You know, I don't know how many of you watched that movie. What's the name of that movie that Tyler Perry just came out with? Straw? Yeah. If you watch that movie Straw, it tells you a lot. Just one little thing sets off the whole thing for the whole period of time that ends up impacting your family. And then for those of you that have kids, how are you handing over this knowledge to the next generation? Generational wealth building. You might not be able to do much because you're getting older, but the kids that you have coming after you, because the school system is not going to teach them financial freedom. What legacy, what education legacy are you leaving for your kids so that they understand how important it is to develop passive assets? So that's in a nutshell what we covered, but like I said, we'll make the replay available. Let me also do this real quick before we hop off.
Hey, Ibir, can I ask one question about the insurance that you mentioned? As you refer to full coverage over your real estate, we're talking total comprehensive insurance. Is that what you were alluding to?
Umbrella.
Oh, umbrella. Okay.
Yes, umbrella insurance. Let me give you guys our YouTube channel. If you go here, all of the recordings that we did is on here. All right, so last question of the day. I'm a licensed realtor in New York and would like to extend my services to the New York person looking to sell. I've been a long-standing client of Ebere and I've been immersed. Okay, can you please email me, Bridget, and I will connect you with the client who is looking to sell in New York. Just send me an email reminder. You said you know people that lost their shirt with incorrect insurance and possibly someone suing them. If you have the property under an LLC and insurance, do you still need an umbrella policy? Yes. I will give you guys a quick referral for that. When you reach out to her, let her know that I referred you. The reason why having a property in an LLC doesn't protect you is what is called the top-down creditor and the bottom-up creditor, right? Somebody sues you, they will not be able to get anything that the property owns, that the LLC owns. But what if they sue the LLC? So you may have protected yourself from the top-down creditor, but you did not protect yourself from the bottom-up creditor. So somebody may not be able to, somebody can sue you and they don't have access to the property because the property is in an LLC. But what if the person sues the LLC? They have access to the equity that is in the LLC. So that's why you need to think about it, that even if you have a property under an LLC or you have it in a trust or you have hazard insurance, that is not enough. You need to have a good umbrella policy. And in some cases, we even ask that you file a friendly lien on the equity that is in the property. That's why you need an overall picture. Just think about all the possible ways that you're exposed. And just having that property in the LLC is not enough. Okay. All right, we have come to the end of our 2025 annual business meeting. Yeah, Tanya, please email me and we can talk about it. Referral for a good bit. All of that, please email me and I'll just simply copy you guys or send you guys the information. I'm gonna stop the recording. Thank you guys so much.